Okay, next table here, budgeted cash payments for purchases. You need to refer to the previous cost of goods sold, inventory purchases table that you did in the previous page. So it tells you that we're paying half of what we purchased this month, and we're paying half of what we purchased from previous month. So basically, all the purchases you made in this month breaks down to two parts. The portion defers to next month. Okay, so just fill in this and figure out the total cash payments for inventory. So for December purchases, you have December sales, right? December sales, then how do you get the inventory that you purchases from December sales? So follow the same inventory policies in the previous to find out December's purchases. Right, the critical part of this table is the first box here, January's 50% of last month's payment. So last month's purchases comes from December's sales. Okay, so December sales is given to you in the previous table, $425,000. And remember, there was a policy of finding purchases. You start from getting cost of goods sold, and then ending inventory, there was a policy having at least $10,000 and half of January's cost of goods sold. If you add them up, the total inventory required, compare that against beginning inventory, which comes from basically December's expected cost of goods sold at $10,000 because this is November's ending inventory. then you get December's purchases. Okay, so this table here, all the other boxes are pretty easy. You need to refer to operating expenses budgets to get to the purchases for January, purchases for February, and then half of it becomes this. Okay, what's critical here is December's purchases. If you're paying half of that, you need to figure out December's purchases first. Okay, so once again, December's purchases, we need to trace back to what is December's expected sales, which is given to you, $425,000. Then, second question is, based on the sales, what is the expected cost of goods sold? 60% of sales. So that will give you $255,000 is cost of goods sold. Then based on cost of goods sold, that's the portion of the inventory that you expect to sell out. Ending inventory is the portion that you expect to keep. So ending inventory, we already got it from previous tables, is $469,000. Remember, it's using January's cost of goods sold, half of that, plus $10,000. So then we calculate beginning inventory. So remember, beginning inventory for December would be basically November's ending inventory. Okay, November's ending inventory. November, it's also given to you what's November's ending inventory. You need to use December's cost of goods sold, again, times 50% plus $10,000. So once you have all these information, when you get purchases, you basically add cost of goods sold with ending inventory minus beginning inventory to get the purchases for December. Purchases. Once you get the purchases for December, then you divide it by 2 because we're only paying half of it in the following month. The other half, we readily paid it in December. Okay, so all the above calculations is referring to this number here. Well, that comes from this. So if you divide, this basically is 259,650, and this is 329,250. Remember that February we're paying 50% of January's purchase. So this is January's purchases times 50% gives you these two. And then February we're also paying 50% of our sales in this month. Right? So this is February sales, purchases, I'm sorry. Okay, so once again, this red highlighted number here refers to December's purchases, and we're paying half of it in January. So December's purchases, you need to use the same logic how we got all the other purchases in the operating budget. In the second table that we got, using the same policy to get to December's purchases. Since you're given sales, and we also got cost of goods sold based on January's, the 60% of sales. You can get this from the given sales. Ending inventory is based on January's cost of goods sold, right? And then you figure out beginning inventory based on December's itself's cost of goods sold. At the end, you can get to December's purchases, and then half of it you're paying in January. Okay, so all the above calculation basically is just referring to the previous table. You can try to add another column as December and fill in all these information.